Welcome back to our Preparing for Retirement podcast. I'm your host, Mark Cram, Certified Financial Planner with Cram Investment Group in Durham, North Carolina. And today we're going to be talking about creating a private retirement plan. This is kind of what we've been leading up to in this series, and today we're going to talk about what makes life insurance such a good vehicle for tax-free accumulation. And how does equity indexed universal life work? And how do I set up my private retirement plan? Well, let's get started. What are the advantages of a universal life contract? Well, universal life gives you competitive rates of return. Typically in the past, these were based on interest rates, just getting a good interest rate return, but today we have other choices, as we will see in just a minute. There are no overcharges, no dividends. These products are straightforward in how they're put together and how they're delivered. There is complete disclosure inside these products of all the loads, fees, and mortality expenses. Unlike a whole life product that you might find really doesn't tell you what's going on inside the product, these products fully disclose how they work. They're completely flexible. You can increase the premium, decrease the premium, stop premium payments if there's sufficient money in the account. You can increase or decrease your death benefits. So these products have extreme flexibility inside of them. And these were developed with something called no-cost loans, which means you could borrow money at a zero rate of interest. Well, now we're in a new era, and we have a new product, something called Equity Indexed Universal Life. So let's look at how this works. Equity Indexed Universal Life is a contract where, unlike the old Universal Life products where they were tied to an interest rate, here what we've done is linked the accounts, the accumulation accounts inside of these products to an equity index. The S&P 500, the NASDAQ, the Dow. There are numerous choices out there in the marketplace. We have a principal guarantee, so we can't lose our principal once this is locked in. We have an annual lock-in of these gains, and we reset our index on an annual basis as well. There's generally a minimum rate of return combined with a maximum cap on the gains. And most of these contracts, especially the new contracts, not only have the no-cost loans inside of them, they have something called a variable rate loan. Using a variable rate loan, what happens inside the contract is when you borrow the money out, it actually is deemed to still be in your product and earning whatever the interest rate or whatever the return of the index is inside of your product, thereby allowing you to perhaps create a positive rate of return on the money that you've actually borrowed out of the product. This allows you to create much bigger income streams later in life, and obviously is a way that maybe this product could last longer for you as well. Well, let's take a look at this idea of annual lock-in and reset of the index so you kind of understand how this works. So what we've got, let's assume we could put $100,000 into this product and that the very first year the market returned a 10% return. Well, we would have earned then $110,000. That $10,000 would be added to our account and would become our new principal. So now we can't lose that principal. So if in the following year the market went down 10%, we're not going to lose any money. We're going to just stay at $110,000. Most of these products will show a 0% return, although some products will actually have a positive return in a negative year. If you were in the market, if you had a product that was actually in the stock market or in the mutual fund market, you would find that your account would actually drop $1,000 below where you started from. If the following year, year 3, the market went up 5%, we would add $5,500 to our already $110,000, leading us to a total of $115,500. Versus being in the market, this is an 8.9% better return, and of course over $11,000 better return than if we had stayed in the market actively. So here's a way that we can get those predictable returns that we talked about in some earlier presentations. This is a way that we can have our money grow, we can take advantage of all the upsides of the market, but avoid the downsides that the market has a tendency to provide us with from years to years. Well, now let's look at creating this private retirement plan. How does this differ from typical life insurance policy that somebody might buy? Well, when you typically go out to buy a life insurance policy, what you probably have done in the past is you've tried to buy the most life insurance death benefit that you could while paying the smallest premium possible. We call this term insurance, and this is what most of us would do and is a good way to provide for our families and for our heirs should we not have the time to accumulate this money. However, we want to do something a little bit different with this policy, this equity index policy. We want to try to buy the least amount of life insurance death benefit while putting the most amount of money that we can into this product. Now, we are restrained by a few tax laws that tell us that we can only put the money in so quickly, and we can only put so much in based on the death benefit that we've chosen. So we are restricted, but we can choose that death benefit, and we can choose the amount of money that we would like to fund and the time period that we would like to fund it over. And if we do this correctly, we will have a legal life insurance product from which we can take tax-free loans from to provide either for items that we might need to buy while we are accumulating this money, cars and real estate and other items that we might want to borrow money for, or ultimately our income in retirement, which would allow us to create a totally tax-free retirement income. Now, the thing we have to watch out for, of course, is funding this too quickly or putting too much money in, which would create what's called a modified endowment contract. If that were to happen, we would actually be in a situation where if we tried to take money out of the contract, it would be taxed and, in fact, penalized if we were under age 59 and a half. So we want to avoid that at all costs. And we have the assistance of the insurance companies because if we send them too much money, they are watching out for this, and they would, in fact, return our premium to us, letting us know that we would, if we left it in, have created that modified endowment contract. So again, just another look at how we fund this. We actually are restrained by these three tax laws, known as TEFRA, DEFRA, and TAMRA, passed in 82, 84, and 88. What we can do is it's going to take us somewhere between 4 and 5 years to fully fund the product if we want to do this quickly. We want to, again, have that minimum death benefit on this product. There are going to be some expenses in here. We're going to have some insurance costs, and we're going to have some internal expenses in this product. If, however, you look at the internal costs over the lifespan of this product, 20 to 30 years, you will see that the internal costs are going to run somewhere between 1.5% and 1.8%, typically in most of these policies, which would not be much more, if not less than what you would find in a typical mutual fund account out in the marketplace. So, in preparing for retirement, we can actually create our own private retirement plan. You can have predictable returns with this plan. You can have liquidity. The money inside this plan is available to you. Typically, 95% of the cash value is going to be available to you at any time after the first year that this policy is in force. And you can take advantage of tax-free growth and tax-free income inside this product. So, join us next time because we're going to be actually looking at some real-life examples of how this product can work and learn more about how you can prepare for your own retirement. In the meantime, please check out the website www.equitymaximization.com, and we'll look forward to seeing you next time.